Have you ever wondered why everyone keeps talking about the S&P 500 or what it really means for your money in 2025 and beyond? Whether you're just getting started with investing or want a deeper understanding of the market's most important index, you're in the right place. In this ultimate guide, I'll break down what the S&P 500 is, how it works, why it matters, and what it tells us about the US economy, all in a clear, beginner-friendly way. So, if you're ready to level up your financial knowledge, let's dive in. So, what exactly is the S&P 500? Why is it called the S&P 500? And does it have anything to do with standard or poor companies? Not at all. In fact, it tracks 500 of the largest and most successful publicly traded companies in the United States, making it one of the best indicators of the overall US economy. The name S&P stands for Standard & Poor's. But who or what is that? Well, it goes back to the 1800s. In 1860, Henry Poor published a guide to help investors understand railroad companies. Later, in the early 1900s, a firm called Standard Statistics began publishing financial data on corporations. In 1941, the two merged to form Standard & Poor's. Then, in 1957, they launched what would become the most iconic stock market index in the world, the S&P 500. It's not about poor companies, far from it. It's about the most powerful, influential, and innovative companies driving the US economy forward. Now you know, the S&P 500 isn't just a number. It's a window into the heart of American business. There are 6 major US market indexes every serious investor should know. Whether you're diving deep into investing or just want to sound smart at dinner, these indexes are your cheat sheet to understanding the US economy. Let's break them down. Number 1, the S&P 500. The S&P 500 tracks 500 of the largest and most influential companies in America, names like Apple, Nvidia, Microsoft, and Amazon. It's widely considered the gold standard for measuring the overall health of the US stock market. Number 2, the Dow Jones Industrial Average, or DJIA. This index includes just 30 companies, but they're blue-chip giants like Boeing, McDonald's, and Goldman Sachs. It's the oldest market index in the US and remains a powerful symbol of economic strength. Number 3, the Nasdaq Composite. Tracking over 3,000 stocks, the Nasdaq is tech-heavy, filled with companies like Tesla, Meta, and Google. If you want to know how the tech sector is doing, watch the Nasdaq. Number 4, the Russell 2000. This index tracks 2,000 smaller US companies, also known as small caps. It's a great indicator of the domestic economy and investor risk appetite. Number 5, the NYSE Composite. This index covers every stock listed on the New York Stock Exchange, across all sectors. It gives you one of the most comprehensive snapshots of the US market. Number 6, the CBOE Volatility Index, better known as the VIX. The VIX doesn't track stocks, it tracks fear. It measures expected volatility in the S&P 500. When it spikes, it means investors are nervous and markets may be bracing for turbulence. Together, these 6 indexes give you a complete dashboard of the US market, from blue-chip stability to tech momentum to investor sentiment and market volatility. Understand these, and you're already ahead of 90% of investors. Why is the S&P 500 the king of all stock market indexes? Because it tracks 500 of America's largest companies, spanning every major sector of the economy. From tech to healthcare, energy to consumer goods, it's all here. Together, these companies represent 80% of the entire US stock market. If the market moves, the S&P 500 feels it. It's also where the money is. Over $15 trillion is benchmarked to the S&P 500. That means trillions of investment dollars follow this one index. Historically, it's delivered a 10% average annual return. That's why long-term investors swear by it. And it's not static. The S&P 500 evolves. Underperforming companies are removed, and top-performing newcomers are added. Only the strongest stay. And the impact? Global. The S&P 500 doesn't just reflect America, it moves markets around the world. So when people call the S&P 500 the king, it's not hype, its history, scale, and staying power. Ever wonder how a company makes it into the S&P 500? Here are the 8 key requirements in under 60 seconds. 1. Market cap. You need a valuation of at least $14.5 billion and high trading volume. 2. US-based. Only companies domiciled in the US are eligible. 3. Public float. At least 50% of shares must be publicly traded. 4. Listing. The stock must be on the NYSE, Nasdaq, IEX, or CBOE. 5. Positive earnings. You need as reported profits in the last quarter and overall past year. 6. Sector balance. The committee considers industry diversity to avoid overloading one sector. 7. Financial strength. No shaky companies allowed. You must be fundamentally sound. 8. Committee approval. Finally, it's up to the index committee. They make the call. Getting in means you're not just big, you're strong, stable, and built to last. The top 50 companies in the S&P 500 are industry powerhouses, spanning technology, healthcare, finance, and consumer goods. Together, they drive over 75% of the index's total market value, despite being just 10% of the companies. As of 2025, the top 10 companies alone dominate the index with a combined weight of 36.1%. Leading the list are Microsoft and Nvidia, each at 6.8%, followed by Apple at 6% and Amazon at 3.9%. Then come Meta platforms, Broadcom, Tesla, Alphabet Class A and C shares, and Berkshire Hathaway. Though they make up just 2% of the S&P 500's members, their massive market caps give them outsized influence, meaning when they move, the entire market feels it. What's changed over time? In 2005, the top 10 included names like ExxonMobil, General Electric, Citigroup, AIG, and Pfizer, mostly from energy, finance, and industrials. Fast forward 20 years, and the list is now dominated by tech giants. The only name that has endured at the top? Microsoft, a rare example of long-term dominance through constant innovation and adaptability. The S&P 500 index is calculated by summing the float-adjusted market capitalizations of all 500 companies and dividing the total by a number called the divisor. Float-adjusted market capitalization means the value of a company's stock based only on the shares that are available for public trading, excluding shares held by insiders or the government. The divisor is a special adjustment factor used to ensure the index remains consistent over time, even when companies undergo stock splits, pay dividends, or are added or removed from the index. This method allows the S&P 500 to accurately reflect the performance of the U.S. stock market. Over the past 40 years, the S&P 500 has delivered strong long-term growth. Despite periods of sharp volatility, the index has remained resilient, with positive gains in most years, making it a cornerstone for long-term investors. A $1,000 investment in 1985 could be worth over $32,000 today. Here are some key statistics about the S&P 500, covering the 40-year period from June 1st, 1985 to June 29, 2025. Long-term returns. Over the past 40 years, the S&P 500 delivered an impressive 10% average annual return, aligning closely with its historical long-term trend. Positive years. Between 1993 and 2024, 78% of the years saw gains. Historically, the S&P 500 finishes positive about 70 to 78% of the time, a strong case for long-term investing. Volatility. The index has shown monthly volatility around 20.8%. In times of uncertainty, the VIX, Wall Street's fear gauge, has surged as high as 89 during the 2008 crisis and 82 during the 2020 COVID crash. What drives these swings? Major drawdowns come fast, but so do recoveries. History shows that short-term shocks are often followed by strong rebounds. In summary, average return, 10%. Inflation-adjusted, 6%. Volatility, 20.8%. Positive years, 70 to 78%. Best year, plus 34%. Worst year, minus 38.5%. Latest record high, over 6,200 in 2025. In short, the S&P 500 has proven to be a resilient engine of growth, weathering volatility and crises, yet rewarding those who stay invested over the long run. Over the past 40 years, the S&P 500 has soared to incredible highs, but it hasn't always been a smooth ride. The biggest S&P 500 downturns from 1985 to 2025 include: Number 1. The Black Monday Crash, 1987. Between August and December, the market plummeted nearly 33.5%, triggered by panic selling and algorithmic trades gone wild. Number 2. The dot-com burst, 2000 to 2002. A tech-fueled mania ended in a brutal 49% drop as overvalued startups collapsed like dominoes. Number 3. The global financial crisis. From October 2007 to March 2009, the S&P 500 lost 57%, its worst plunge in modern history, sparked by the housing bubble and widespread bank failures. Number 4. The COVID crash, 2020. In just 1 month, the index sank 34% as fear over a global pandemic shut down economies overnight. Number 5. The 2022 bear market. Driven by inflation, rising interest rates, and recession fears, the S&P 500 dipped 25% from January to October. Number 6. The 2025 tariff shock. From April to June, renewed U.S.-China trade tensions triggered an 18% decline, rattling tech and industrial sectors. And don't forget these notable corrections. The 1990 Gulf War recession, down 20%. 2011's U.S. credit downgrade, off 19%. And a 20% drop in 2018 amid Fed tightening and global trade worries. But here's the secret. Even after massive crashes, the S&P 500 always found a way back, stronger than before. It finished positive in 32 out of the last 40 years. Key lessons learned. Lesson 1. Time in the market beats timing the market. Lesson 2. Crashes are normal, but so is recovery. Lesson 3. The S&P 500 isn't just an index, it's a mirror of our economy's evolution. Stay the course. Understand the history, and let the power of compounding and resilience work in your favor. Several key long-term factors have driven S&P 500's sustained growth. First, corporate earnings growth. Earnings per share, or EPS, of S&P 500 companies have steadily increased due to productivity, innovation, and globalization. Profit margins expanded significantly in tech, finance, and healthcare sectors. Second, technological innovation. The rise of personal computing in the 1980s and 90s, the internet boom in the 90s, the mobile era in the 2000s, and the AI and data economy in the 2010s and 2020s all fueled exponential growth. Companies like Apple, Microsoft, Nvidia, and Amazon became mega-cap leaders. Third, falling interest rates. The Fed slashed interest rates from 20% in 1980 to near zero after 2008 and during the COVID-19 pandemic. Low rates boosted borrowing, investment, stock buybacks, and equity valuations. Fourth, globalization and market expansion. U.S. companies expanded internationally, opening access to emerging markets and global supply chains. This helped firms grow revenue and profit beyond U.S. borders. Fifth, Federal Reserve policies and quantitative easing. After 2008, quantitative easing, or QE, injected liquidity into markets. Easy monetary policy supported asset prices and investor risk appetite. Sixth, the rise of index and retirement investing. The explosion of 401k, IRAs, and passive investing, like the SPY ETF, drove consistent capital inflows into the S&P 500. Today, index funds hold over 20% of the market. Seventh, sector shifts, from industrial to tech. In 1985, the S&P 500 was dominated by oil, manufacturing, and banks. Today, tech and communications make up over 40% of the index, bringing higher margins and faster growth. Eighth, stock buybacks. Companies used profits and cheap debt to repurchase their own shares, reducing share float and artificially boosting EPS. The buyback trend particularly accelerated after 2008. Ninth, inflation control and stability. After the early 1980s, inflation was largely under control for decades. A predictable macroeconomic environment allowed for long-term equity growth. And finally, 10th, economic growth and population expansion. U.S. GDP nearly quadrupled since 1985, and consumer spending kept growing. Population growth and innovation fueled long-term demand. How to invest in the S&P 500. Investing in the S&P 500 is one of the simplest and most effective ways to build long-term wealth. Here's a step-by-step guide. Step 1. Understand what you're investing in. The S&P 500 tracks the performance of 500 of the largest U.S. companies across various industries, like Apple, Microsoft, Amazon, and Google. It's a diversified, low-cost way to invest in the U.S. stock market. Step 2. Choose an investment vehicle. You can't buy the S&P 500 directly, but you can invest in it through index funds and ETFs, exchange-traded funds. Both track the S&P 500's performance and offer broad market exposure at low cost. Index mutual funds, like Vanguard's VFIX, are great for long-term investors and often allow automatic contributions. ETFs, like SPY or VOO, trade like stocks, offering flexibility and intraday pricing, which makes them ideal for active or cost-conscious investors. Step 3. Open a brokerage account. Use a trusted brokerage like Vanguard, Fidelity, Charles Schwab, E*TRADE, or Robinhood. You can also use robo-advisors like Betterment or Wealthfront that automatically invest in the S&P 500 for you. Step 4. Decide how much to invest. Start with a lump sum, or use dollar-cost averaging, investing regularly over time. You can begin with as little as $50 to $100, depending on the platform. Step 5. Invest regularly and reinvest dividends. Set up automatic contributions. And reinvest your dividends to benefit from compounding growth. Step 6. Stay consistent and long-term focused. The S&P 500 has historically returned about 10% annually, around 6 to 7% after inflation. Resist the urge to time the market. Think long-term, at least 5 years, and avoid panic selling during downturns. Bonus tips. Use tax-advantaged accounts like Roth IRAs for 401(k), S, or HSAs if you're eligible. And always check the expense ratio. Lower is better. For example, VOO's is just 0.03%. S&P 500 mutual funds are index mutual funds designed to track the performance of the S&P 500, offering broad exposure to 500 large U.S. companies. Examples include Vanguard 500 Index Fund, VFIX, Fidelity 500 Index Fund, FXAX, Schwab S&P 500 Index Fund, SWPPX. These funds are managed by trusted providers, Vanguard, Fidelity, and Charles Schwab, and are known for their low costs and long-term growth potential. S&P 500 ETFs are exchange-traded funds designed to mirror the performance of the S&P 500, allowing investors to own a slice of the top 500 U.S. companies. Some popular examples are SPDR S&P 500 ETF, SPY, by State Street. iShares Core S&P 500 ETF, IVV.
Vanguard SP500 ETF, VOO.
These ETFs trade like stocks and offer a low-cost, flexible way to gain broad market exposure. The key differences between an S&P 500 mutual fund like VFIX and an S&P 500 ETF like VOO lie in how they're traded, invested in, and taxed. Mutual funds are priced at the end of the day and typically require a higher minimum investment, often $1,000 or more, but they support automatic investing. ETFs, on the other hand, trade throughout the day like stocks, can be bought with as little as one share and are generally more tax efficient, but they usually require manual investing setups. Final thoughts on the S&P 500. The S&P 500 is often seen as the gold standard of long-term investing. But before you put your money in, there are risks you shouldn't ignore. First, market volatility. The S&P 500 can drop sharply during recessions, global crises, or periods of high inflation. It's happened before in 2000, 2008, and 2020. Next, overconcentration in tech. As of 2025, a significant portion of the S&P 500's performance comes from just a few tech giants like Apple, Microsoft, and Nvidia. That makes it more vulnerable to a tech sector downturn. Third, it's not truly global. The index only includes US companies. So if global markets outperform the US, your portfolio might lag, unless you diversify internationally. And finally, sequence risk for retirees. If you start withdrawing during a market dip, like in early retirement, poor timing can hurt your long-term sustainability. Now, let's bust a few common myths. Myth 1. You can't lose money in the S&P 500.
Wrong.
Short-term losses are very real. The index has dropped over 30% multiple times. Time horizon matters. Myth 2. It's always diversified. Not quite. While it includes 500 companies, it's market cap weighted, so the biggest firms dominate. Myth 3. It beats all other investments. Not always. In certain decades, bonds, international stocks, or even gold have done better. Myth 4. It's a set-and-forget investment. Even passive investing needs attention. You still have to rebalance, review your goals, and manage taxes. So, what's the bottom line? The S&P 500 is a time-tested, low-cost way to build wealth, especially if you invest consistently, reinvest dividends, and stay long-term focused. But remember, no investment is risk-free. Knowing the risks and respecting the myths will help you become a wiser, more resilient investor.